Hello, everybody, and welcome back. It's all over the news. It's all anybody's talking about these days is dropping house prices, rates going through the roof, inflation. Everything is top of mind, I think, for more people than it usually is. It's grabbing all the headlines these days, is what it seems like. And to kind of dive further into these discussion points and these topics, I want to welcome back Sergey Modilevsky, mortgage broker. Maybe to kick off, we can talk about the most recent announcement in the news, which is actually today, the day of recording. Canada puts out its inflation report for this month. New record, and not in a good way for people, but we're up to 7.7% inflation. It's the highest since 1983. Talk to me about that. What are you seeing? How's that impacting things? What is driving this inflation?
Well, speaking specifically first about the inflation report, so it was May's Consumer Price Index report. Most of the gain that we saw was in headline inflation. So what we're talking about there are grocery costs, food in general, and shelter costs and transportation. They have the largest weighting in the CPI basket. So there are other categories that went up at a faster percentage pace, but these have the largest weighting, so they have the greatest impact. And food prices, frankly, are driven largely by their input costs. So before you end up buying at the grocery store, if we trace it all the way back, we're talking about farmers potentially, or large agricultural builds. And there you start with things like fertilizer prices, wheat prices, and other commodities. So anytime you're using farming equipment, you're using oil. And these commodities have all skyrocketed in price, natural gas included, and it's pretty much a laundry list. And that started to escalate, obviously, once the war began in Ukraine, and got exacerbated when the lockdowns in Shanghai started to take place earlier on this year. So you saw a huge spike in commodity costs, and now that's slowly filtering its way from production cost increases to now retail price increases. And that's also, in that process, as inflation has grown, borrowing costs on mortgages have also gone up. As a result, rents have also gone up. So that's caused a huge spike in shelter costs, which is also one of the largest drivers of CPI in Canada. And as a result, now we're seeing this huge headline number of 7.7%. Beneath those four primary drivers, you've got sort of the sub drivers, and those have risen at a much smaller pace. So anything related to imports, for example, furniture costs are up 29% year over year. And they grew month over month as well, because shipping costs from China had been exacerbated into the late 2021, and they've since started coming down. But all of that takes a little while to feed through. So I would say, the four main drivers are related to input costs. And there's reason to believe that we might slowly be at that tipping point where we've either had the highest inflation reading we're going to have, or we'll have one or two more higher readings. And there's reason to believe that that may end up being the peak. And we can get into that a little bit as well.
So then, with that peaking out, what does that mean in terms of, I guess, these aggressive rate hikes that have been happening with the Bank of Canada? Maybe it makes the most sense to go there for our people. We know since the start of the year, our overnight rate is now sitting at 1.5%. Up from 0.25% early in the year when they kind of dropped it right around the start of the pandemic. It's being talked that the Fed in the US just raised their rate by 75 basis points as well. Canada kind of needs to keep lockstep with the US, is fair to say, I think.
Yeah. When you're talking about the pace of interest rate hikes and how the two countries are related, it ultimately comes back to the dollar. And if you're not increasing your borrowing costs, you're kind of creating this additional force of inflation, which becomes the foreign exchange rate. So if you don't keep pace with hikes in the United States, the value of your dollar comes down. Any imports that you bring into the country have this surplus tax, which is now inflation based on the currency exchange. So typically you're going to see the move, if not in lockstep, then something very closely to that. The inflation rate has only been roughly 1% different in the US versus in Canada, related to a few different factors. We're likely to keep in lockstep. So July 13th is the next Bank of Canada meeting. Expectation now is for 75 basis points to be put on the table. It could even be higher than that, but we'll keep our fingers crossed that they limit it to 75 right now.
Can you just talk a little bit about that then, in terms of your thoughts? Is going 100 basis points just too much? Like, what does that signal if that were to be the case?
Well, it's difficult to know what's too much. There's a lot of inputs that go into consumer price index readings, but it's important to realize that these readings, when they come out, they end up being a lagging indicator of what's happening in the economy. So you're looking back. And looking forward, the circumstances may be a little bit different. So interest rates have climbed precipitously since you and I last spoke. I think at the time, don't quote me, but they're roughly around maybe low threes on a 5-year fixed mortgage rate. Today, we're above 5%.
Right.
Also, anybody who qualified for a mortgage back then had qualified at low threes now, or maybe even lower. Now they're requalifying at 5.25 on average. So the circumstances have changed a lot. And a lot of that demand destruction is starting to be slowly reflected in the economy. So you're starting to see different sectors slowly cutting jobs. We're in the first inning of what might end up being a 9-inning game in that respect, but it's there, it's prevalent. We're also seeing a little bit less demand than what was expected coming out of lockdowns. So we saw what we hope are maybe peak commodity prices a little bit earlier on the year, maybe around 30 days ago, depending on the commodity. And they've since sort of trailed off a little bit, showing that lack of demand. GDP is down in Canada and the United States. It's coming well below economists' forecasts from the last 60, 90 days. We're starting to see a little bit of demand destruction already taking place. We're also seeing some of that upward pressure on commodity prices ease off a little bit. So especially over the last couple of days, you've really seen the 5-year bond yield come down in Canada, which is a leading indicator that mortgage rates may be coming down in the near term. We've also seen everything from lumber, oil, wheat, corn, metals, all these different input costs starting to trend down. Fertilizer, which had tripled from, I want to say earlier this year, or maybe late 2021, it's now also down about 20, 30% from its peak. So all these input costs are slowly coming down, but producers are still feeling a lot of that inflationary pressure because they're the ones who deal with the input costs. And most recent readings on the producer price index were astoundingly high, particularly in Europe, to slightly lesser degree here. And that's going to take a couple months to filter through the system. But if we continue to see downward pressure in input costs and other commodities, then eventually in the latter part of this year, you might see that reflected in CPI readings. And we're already seeing a lot less demand for things like household goods, retail products like clothing, et cetera. There's a bit of a greater demand for services and travel. But once that finds a bit of a middle ground, if fuel prices come down, the price of things like air travel comes down, the price of finished goods comes down. So I think that's the one to really watch. Commodity price across the board, but even more specifically, energy prices will bring down the cost of all things. And specifically, agriculture input costs like fertilizer will bring down the cost of food. And the cost of freight, I think, is a really interesting one to watch as well. Global freight prices are down roughly 36% from their peaks. So that's sort of the perfect storm that we're looking for to bring down inflation. Lower oil prices, lower freight prices, and lower input costs overall.
In the meantime, really the Bank of Canada, all they can do is react to these CPI reports and inflation numbers and make their decisions based on what's happening down in the Fed too. So we talk about a 75 basis point rate hike. More than likely, I think last I read it was kind of 80% baked in that it was going to be 75 basis points on July 13th.
Yeah.
What effect is that going to have on the kind of Canadian homeowner in terms of either current mortgages or applying for new mortgages?
Well, on existing homeowners, there's sort of three categories. There's anybody holding an adjustable rate mortgage, a variable rate mortgage, and a fixed rate mortgage. An adjustable rate mortgage is where your payment changes based on changes in prime rate. That is a direct effect. Once that rate goes up, your payment will change accordingly. And, roughly $12 for every 25 basis point of hike on every 100,000 in mortgage. So you could do the math on your own mortgage that way. And anybody holding a variable rate mortgage, what they're seeing is that their equity position, their principal to interest portions of their payment are going to change. So as the overnight lending rate goes up, your amortization will go up, which means you're going to pay less towards principal and more towards interest. Not the best position to be in, but if you wanted to mitigate that, all you have to do is increase your payment, and that'll mitigate how much your amortization goes up. If you're in a fixed rate mortgage, you remain unscathed. Obviously, you would be affected if your mortgage comes up for maturity, though. And if you're somebody new looking to get into the market, it's actually a material change. So what's happening now is there's two sets of qualifying rates if you're looking for a new mortgage. There's qualifying based on a variable rate, and there's qualifying based on the 5-year fixed rate. And the current stress test rules are that you have to qualify at the greater of these two. So a 5-year fixed rate is at, give or take, 5.25%. So the qualifying rate would be 7.25%. That's why there's an incredible spike in demand for variable rate mortgages, because you have more borrowing capacity. So right now, just as an example, depends on the mortgage, the lender, but a rough variable rate might be somewhere in the vicinity of 3.1%. That would mean that the qualifying rate on a variable rate mortgage is still 5.25. After we see a 75 basis point hike, and that variable rate mortgage moves to, for example, 5.85, now you're looking at a qualifying rate, even on a variable rate mortgage, of 5.85 instead of 5.25. So your borrowing capacity overnight becomes squeezed another, give or take, 6%. So all of that creates downward pressure on demand. And there's two sides to it. There's demand and supply. Borrowing rates ultimately can only control the demand side of the equation. Right. The Bank of Canada is doing their part to mitigate that as much as possible, as quickly as possible. Long-term bond yields are already pricing in the possibility that central banks hike too aggressively in the near term and then have to walk that back at some point in late 2023 or early 2024. So the immediate effect is that it squishes demand down, pushes downward pressure on asset classes like housing and others, and hopefully that reins in inflation quickly.
Are you seeing that from your perspective in terms of, I feel like as the realtor out there day to day, that is the big thing we're up against, is these raising rates, and that is what is driving home prices down, kind of thing. We may see a little flurry in the next little while as people try to get in before their rate holds expire. But I'm trying to think of, it's got to be coming up pretty soon that rate holds of whatever a good 5-year fixed was maybe 2 months ago, they'll be coming up in the next 2 months too.
Yeah, even 2 months ago, like those rates are already creeping up pretty high, and they will be coming up. I think it's safe to assume that by late summer, everyone requalifying will have a minimum qualification rate of 5.85 based on a variable, likely even higher than that. I could easily see it being in the mid sixes by that point. And a 5-year fixed rate, assuming it didn't change from where it is today, is going to be qualifying somewhere in the neighborhood of 7.25. Qualification and borrowing capacity is certainly one part of the equation. It doesn't just limit the primary borrowers on an application, but it also affects any potential co-signers that they would be getting. And believe you me, in this environment, a disproportionate number of buyers have either a co-signer on there or they have a gifted down payment, both of which are affected by rising interest rates. So if you have a family member who is interested in co-signing, borrowing capacity is higher overall, makes it more difficult to qualify. If they were looking to provide a gifted down payment, a higher borrowing cost means that they would have to draw that money out from their line of credit. For every $100,000, they're now paying an additional roughly 3% of borrowing cost on that money. So somebody has to service that debt and have the desire to, and that just makes creates a lot of downward pressure on prices in the near term, especially when you don't know where the borrowing limit will be. So if you're a parent taking equity out of your own home, today your borrowing cost, you're expecting that 1-year borrowing cost on that money to be somewhere in the neighborhood of 3.5% to 4%. But by 2023, you might have concern that might be 4.5%. 5%. And at the same time, you're feeling the destruction of the wealth effect because you're looking at your stock portfolio. Depending on what index you're in, you're down somewhere in the neighborhood of 20 to 30%. Even previous portfolios, like a balanced portfolio that was 50% stock, 50% bonds, there's nowhere to hide. Right. Every asset class is being eroded as interest rates rise. So as that all takes place, you've got parents more reluctant to draw on equity or to sell investments at a loss or off their peak prices in order to provide those down payments. So creates a lot of downward pressure and demand. Most
definitely. I guess getting back to what should somebody be taking now, new home buyers, what are we recommending to people? I know it's situation dependent, but let's just talk about that question. Everybody wants to have that question answered.
Yeah, well, like you said, it is specific to the individual. But that being said, there are a couple of things that you obviously want to be conscious of. You know, when you take a 5-year fixed mortgage, you do get the guarantee that your payment will be locked in for that period. But today you're locking in mortgage rates somewhere around 30 to 40-year highs. And as a result, you're going to guarantee a high housing payment moving forward. You're also going to lose the flexibility if the economic circumstances change or if your personal circumstances change to break out of that mortgage with a reasonable penalty, restructure amortization, consolidate debt, do an equity takeout. In the future, it's going to become increasingly more difficult to borrow in the form of a line of credit. You lose a lot of that flexibility to become reactive. You're also locking in a 5-year cost at 5% plus, and that's well above the historical average that we've seen. So those are the benefits and drawbacks of the 5-year fixed product. A variable rate product ends up being somewhere in between. You absorb a much lower payment today, And that payment will actually be fixed. And the only thing that's going to move around is your amortization unless rates skyrocket and we see it trigger what's called the trigger rate in a variable rate mortgage. And we could talk about that quickly afterwards as well.
Yeah.
With that sort of product, you maintain the flexibility to pay a 3-month interest penalty, break out of your mortgage, and capture a better variable rate discount that becomes available. So 6 to 12 months ago, if you took out a variable rate mortgage, it was based on 2 things: prime, and then there was a discount. So prime minus, and at the time, it averaged roughly prime minus 1%. Mm-hmm. Today, with the expectation of volatility in borrowing costs in 2023, 2024, the discount has shrunk dramatically. So anybody taking a new variable rate product is seeing something more like prime minus 30, prime minus 40 on an uninsured mortgage. So there may come a time during that 5-year term where if you're in a variable rate mortgage today, you could break that, pay a 3-month interest penalty, possibly have it rebated, and then move to a far steeper discounted variable rate mortgage, even as prime rate falls in the years to come. So there's something to be said about the flexibility of having that. I would recommend that sort of product for somebody who has income stability, who has a greater cash flow than expense. So if they're net positive every month and they're setting money aside into TFSAs, RSPs, and additional savings, and they've got that flexibility, there's a lot to be said for a product like that. And then lastly, there's an adjustable rate mortgage, which is like a variable rate mortgage. It goes up and down with prime rate, but your payment actually changes. And that's not necessarily a drawback because a lot of folks don't want their amortization to rise, but similar rules apply. If you've got some flexibility in your income, if you're operating at a surplus, if you haven't found yourself accumulating debt when borrowing costs were at 1.5%, 2.5%, then you know you've got the financial discipline to be able to manage through that kind of product, even if rates rise a little bit. That would be a suitable product. If you were refinancing at rates of 1.5%, 2.5% for the purpose of consolidating debt, now's really a time where you have to be conscious of a couple of things. Even if you take a 5-year fixed mortgage, you really want to understand that you may not have the ability to refinance that in the future. And now you're jeopardizing all the money that you put in to acquire that property. So land transfer tax, legals, et cetera, plus the selling commission if you have to sell out of necessity. So a variable rate product might be suitable for somebody who has found themselves in that situation in the past. They want a fixed payment. They'll accept that their amortization may go up because they need the flexibility to break out of that mortgage if they find themselves going through a little bit of volatility in their personal and professional life.
Sure. Talk to me, because it was something I was actually going to ask you about, the variable rate mortgages, the trigger.
Yeah, the trigger rate.
The trigger rate. Because it was something that I think people maybe weren't, not that it wasn't highlighted, when things are good, things are good. And then when things start to turn, people start to realize different maybe components or clauses or things about their product that they signed up for, including this trigger rate. So talk to me about that. And I guess, are you seeing that yet? When does it get to that point where a trigger rate would be pulled?
Yeah, different lenders will have different trigger rates based on when the mortgage was originally taken, but any lender with a variable rate product, so not an adjustable, but a variable where the payment's fixed. So that's everyone from TD, HSBC, CIBC, BMO. There may be some others I'm overlooking right now, but they all have a trigger rate. And essentially that's the point at which they've essentially increased your amortization to the point where you're more or less making an interest only payment. And anything above and beyond that, now that's principal that's owed back to the lender. So when it hits that trigger rate, a lender will often re-amortize the full mortgage back to 30 years. Or my apologies, back to the original mortgage term, right, in order to ensure that they're still collecting a sufficient amount of principal. Historically, we haven't found ourselves at any point approaching that trigger rate, but these are obviously unique times. We're still a ways away. The typical trigger rate for most lenders will see prime rate approaching 4 or 5% before you get to that point. But even when you do, the reality is, if you're in a variable rate mortgage, you really have to be conscious of what you've experienced up to this point. So you have been saving money compared to a 5-year fixed rate if you had taken the mortgage 12, 24 months ago, right, up until very recently, as interest hikes have escalated over the last 3 months. You've been saving money. That's money that you've either been setting aside, maybe you've been putting into your tax-frees, possibly your RSPs, or just regular non-registered savings. That money that you've been putting away, there needed to be the understanding that that money was going to be deployed in one way, shape, or form. If you've got the cash flow, then what you want to do is start increasing the payments on your variable rate mortgage in anticipation of even approaching the trigger rate. We may never get there, but whether we do or don't, now might be an appropriate time to start increasing that payment and reducing that amortization. It will not take a dramatic increase to start reducing it. If you don't want to do that yet, then you at least want to set up a pre-authorized contributions from your checking account to your savings account in anticipation that that may be a requirement at some point down the road here. So these are new times. We'll see where the next couple of rate hikes take us. I would imagine that the Bank of Canada and those who make decisions are keenly aware of the trigger rate. There's been a lot of discussion around the adoption of variable rate mortgage over the last 24 months. There was a huge spike. So there is a very large segment of the population that's going to be dealing with that circumstance as we approach Q3, Q4 of 2022.
Most definitely. I feel like that's a pretty good spot for us to wrap this talk up, Sergey. I will put all your information down below in the description of the video, but where can people find you and the content you're putting out as well?
Well, they can find me on YouTube under Sergey Modilevsky. I'm also on Instagram as DIY Finance Guy, and they can obviously get in touch by email, Sergey Modilevsky, sorry, my apologies, Sergey M at dominionlending.ca. And yeah, full contact details will be below.
Beautiful. That's amazing. I hope this video brought some value to everybody. Smash that like button, subscribe, all that good stuff to us. And we will bring you another one of these in a couple months' time.
Awesome. Thanks so much, Rob. Appreciate your time.
Of course. Cheers.